When the Singapore Exchange revealed plans for special purpose acquisition companies, or SPACs, earlier this year, there was plenty of excitement around these listing vehicles. SPAC activity was at its height in the US. Now activity has leveled off slightly as regulatory scrutiny intensifies.
The avenue for companies to take advantage of SPACs, especially for high-growth companies, to rely on SPACs, and for investors to rely on sponsors to have great acquisitions that they can build on and create value for the investors, I think that will remain for the long haul.
Last month, SGX finalized the rules for the listing of SPACs. Since then, there have been various reports of different players eyeing such listings, including Temasek's Vertex Holdings, Vickers Venture Partners, and European alternative asset manager Tikio Capital.
We've been getting a lot of interest from across the Asia-Pacific region, really, from sponsors who are keen to better understand as well as explore the possibility of listing here. And these are Asian sponsors, not only from Singapore and Southeast Asia, but really from broader Asian region, including North Asia, Japan, Korea, as well as some interest from the West as well.
SGX also told MoneyMind that the first few SPAC sponsors could list soon.
We do expect that there will be a initial SPACs listing imminently in the weeks ahead, hopefully before the end of the year.
The introduction of SPACs comes amid the lackluster performance of IPOs on the Singapore Exchange. Refinitiv data showed IPO proceeds from January to September were $244.4 million. That compares to the low of $541.1 million raised in 2018. Around the world, IPOs have been on an uptrend since 2019, but as seen on the yellow line, Singapore has bucked the trend. In 2021, Refinitiv data showed Singapore made up just 0.06% of global IPO proceeds. So could SPACs give a new lease of life to the Singapore bourse?
There will be companies that are going to list in the US. It's not going to be all companies, and that's where SGX is proposing a very, very good alternative.
The exchange is banking on its geographical advantage to position itself as the gateway to Southeast Asia.
These are companies that operate in the Asian time zone, where they are closer to the market, as well as they have immediate access to their investor base here. So these companies see it as an advantage to consider a listing via SPACs on the Singapore Exchange.
But for SPACs to really take off, there will have to be a sustainable pool of startups and companies looking to list.
The number of companies that have not only come to fruition, but are at a stage where they are expanding across the region, raising more significant rounds. We're now seeing top tier funds from the US putting money to work here in Singapore and looking at target companies to invest in. I think those signs are very, very important and are a proof that we're actually seeing enough companies and a big enough pipeline.
Venture capital firm Golden Gate Ventures says many of these companies could list within the next 3 to 4 years.
We are seeing interest across the board from the various technology verticals, be it fintech, consumer tech, e-commerce, prop tech, biotech, medtech. We are also seeing some interest out of consumer sector. Both FMCG as well as F&B plays have shown some level of interest. The defining feature of all these companies are that they are fast growing and they are expanding their geographical footprints in a very significant way.
To provide further support to the listing ecosystem in Singapore, the government has pumped in 1.5 billion Sing dollars to support high-growth enterprises seeking a public listing in Singapore, as well as $500 million to fund late-stage companies working towards an eventual listing here. The initiatives aim to broaden Singapore's attractiveness as a financing hub for both local and regional growth enterprises.
This is going to be important for companies that are going to list. So giving them an avenue to raise institutional capital as they are listing is going to be a success factor.
The cash incentives only go so far, though.
You need an institutional market that has interest to invest here. You need global investors that have interest to invest here.
The small retail investors are important for a well-functioning market too. Retail investors have shied away from the markets because of low trading volumes and valuations. A check on the SGX website shows more than half of the listed stocks are trading below book value. The Society of Remaisiers believes more could be done to bring back retail investors. The Society's president highlights the list of suspended stocks as one of its biggest concerns. There are currently 78 stocks which are suspended, some as far back as 2015.
It's like a black hole like that, how long the investigations will take, and also when these companies will be relisted. Quite a number of investors, their money, hard-earned money is being locked up. If we hit once, twice, their confidence is shaken in the sense that, hey, will these companies will be relisted or is my money gone forever?
According to market players, retail investors are coming back.
Last year was an incredible year for us as the markets recovered. And we thought that that might be an anomaly. But in the first 6 months of this year, we quadrupled our assets. So the interest in the retail sector is definitely there.
The retail investor activities on SGX has grown quite significantly. In fact, it is 40% higher than the previous year. In addition to that, I think that in terms of our daily market average volume, it's at 1.35 billion, which is at an 8-year high. So it tells you that the vibrancy of the market is coming back.